When we think about equity returns, it's easy to focus on growth, but dividends have historically played an important role. Dividend yield and dividend growth have been major components of total returns across markets. Over the long term, a significant proportion of returns has come from the compounding of dividends and dividend growth, not just price appreciation. Mature dividend-paying companies have also tended to provide increased downside protection during market drawdowns. But markets today look quite different. Many of the largest companies, particularly in technology and AI, are reinvesting heavily into growth and innovation. That supported strong performance, with income playing a smaller role in returns more recently, despite some of these companies beginning to introduce or grow dividend payments. Alongside this, markets have become increasingly concentrated, with a smaller number of companies driving a large share of returns. So this brings diversification back into focus. In a market where returns are increasingly driven by a relatively narrow group of companies, looking more broadly, including beyond individual regions, can provide exposure to a wider range of different drivers of returns. This can be particularly relevant in a global context, where different regional leadership can vary unpredictably over time, rather than following a single regional cycle. That's why we think there can be a benefit to blending a diversified global approach alongside regional building blocks.